In this lesson, we will learn about basic acquisition financing. This lecture will cover the following. 1. What is acquisition financing? 2. Key financing sources. 3. Debt versus equity considerations. 4. Understanding key dimensions of financing. 5. Case study. When companies embark on acquisitions, they need to decide between debt and equity financing. These decisions are influenced by factors like cost, flexibility, and impact on ownership, with each financing type having its specific advantages and trade-offs. Debt financing. Debt financing involves borrowing funds from lenders, typically financial institutions like banks, investment banks, or insurance companies. These lenders provide the necessary capital in exchange for regular interest payments and the return of the principal amount on a predetermined schedule. Advantage. The primary advantage of debt is its cost-effectiveness, particularly in environments where interest rates are low. Interest payments on debt are also tax-deductible, which can further reduce the net cost of borrowing. Disadvantage. However, debt increases the company's financial leverage, meaning that during times of economic downturn or poor business performance, the risk of default can increase significantly. Moreover, debt imposes a fixed repayment obligation, which can constrain a company's cash flow and reduce financial flexibility. Equity financing. Equity financing involves raising capital by issuing new shares of stock. This type of financing can attract different investors. Private equity firms. These specialize in investing in companies, often using a combination of debt and equity and focusing on potential high returns. Strategic investors. Existing companies in related industries seeking synergies or strategic benefits with the target. Public markets. Selling shares on a stock exchange, IPO, can raise significant capital for large acquisitions. Advantage. Equity does not burden a company with mandatory interest or principal payments, providing financial flexibility. It allows companies to tap into a wide pool of funds without the constraints of collateral, ideal for asset-light or high-growth companies. Disadvantage. Selling shares dilutes the ownership stake of existing shareholders, potentially reducing their control. Equity investors expect higher returns than debt providers to compensate for the additional risk they take on. Strategic considerations. Debt financing preference. Mature companies with stable cash flows. These companies can reliably handle regular debt payments, benefiting from the lower cost of debt. Acquisitions with tangible assets. The target company's assets can serve as collateral, making lenders more comfortable providing debt. Equity financing preference. High growth potential. When significant upside is expected, sharing future profits with equity investors can be attractive. Need for flexibility. Equity is less burdensome if the company requires breathing room with repayments or its cash flow is less predictable.